See you later.
Okay. So we have hit the high notes. We know our financial statements. We know how to debit and credit. We know how to make financial statements. We're good with all of that. That will do you very well as you enter intermediate accounting. Okay. I'm sorry. I know. Okay, so now what we're doing, now the purpose of what I'm going to do for the next hour and a half or whatever, is we're going to walk through and hit the high notes for some accounts and chapters that we're going to be hitting more detailed notes in intermediate. Okay, so you're going to have a chapter just like in the introductory textbook. We kind of walked down the balance sheet and stopped and talked about cash and then accounts receivable and then inventory or whatever. You're going to do that again in intermediate accounting. Okay, but you're going to dig deeper each. Okay, you're going to dig deeper in each account. So what I'm doing today is I'm going to make sure that you have mastered this, or give you confidence that you have already mastered this, and then you're going to build onto it next month or whatever, next week. Cool? So I'm skipping cash. Cash is easy. So accounts receivable. Okay, we're going to hit the high notes for accounts receivable. If you remember, accounts receivable is an asset. Yes? Okay? You sell things, they don't give you cash right away. You record a revenue. You record an outstanding IOU from your customer in the form of accounts receivable. It's an asset because it turns into cash at some point in the future. It has value to you today. Okay? Accounts receivable are assets. They have value for you today because they're going to turn into cash. Okay? The reason we stop and talk about accounts receivable in this class and in intermediate classes is because 100% of our customers do not pay us back. Believe it or not, 100% of our customers don't pay us back. So we've got this funky account called our allowance for doubtful accounts that we have to take into consideration for those ding-dongs out there that decide that they don't want to pay us back for what they have already purchased from us or what they have already received from us. Okay, so I'm going to walk through some basic journal entries related to accounts receivable, and then we're going to do a problem. Okay, so if I'm going through this, and this is straight from the textbook, you may remember this from the spring, you may remember this, all of this is from the textbook that you used in 2301, so you may remember this from the spring or whenever you took your intern class. This is a good review. We've got Jordache Company, and on July 1st, they sell merchandise on account to Polo Company for $1,000, terms 210 net 30. Prepare the journal entry to record this transaction on the books of Jordache Company, okay? So 210 net 30 is a quick little reminder. 2-10, comma, N dash 30 or whatever, slash 30. 210 net 30 is the way to pronounce that. What that means in sales terms means that the customer, when you sell something under the terms 210 net 30, the customer gets a 2% discount if they pay their outstanding receivable within 10 days. 2-/10. Okay? If not, the net amount, the entire amount, is due from that invoice in 30 days. Okay? 210 net 30. It can be 5, 15, net 50. The numbers can be anything. Okay? These are pretty common ones, 210 net 30. Okay? So, we sell $1,000 worth of stuff under terms 210 net 30. So on that day when we record that, when we sell those jeans, we record a debit to accounts receivable. Oh, sorry, a debit to accounts receivable and a credit to sales revenue for $1,000. Okay. The other thing that we don't have right on here is the fact that we also have to record the fact that we sold jeans. So we have to record a cost of goods sold and a reduction to our inventory, which we'll talk about in about 5 minutes. But another journal entry that's not included on here, that anytime you sell something, you've got 2 things that you need to record. You need to record the sale right here, okay, by debiting accounts receivable or cash. In this case, it's accounts receivable, and crediting revenue. Record the sales revenue. You also need to record the fact that you no longer have 10 pairs of jeans in your warehouse anymore. You have given them to your customer. You've sold them. So the other journal entry would be to record that expense called cost of goods sold. So you debit cost of goods sold for whatever those jeans were worth to you, and you credit inventory to reduce the value of that inventory that you still have sitting in your warehouse. Okay, so if you had bought them from somebody else for $500, you would reduce the inventory for $500 by crediting inventory and debiting your cost of goods sold, okay? Okay, so, but we know how to record a sale using accounts receivable. Now, on July 5th, 5 days later, they return merchandise worth $100 to DoorDash. So we had sold them 10 pairs of jeans, they bring back one of the pairs that's worth $100 and say, just kidding, we don't want it. So we had originally recorded a sale, now we need to undo part of that sale, okay? We need to undo part of that sale. The way we do it, we don't do it by debiting sales revenue. We actually debit a different account called sales returns and allowances. We like to keep track of our sales and then our returns and allowances as a part of those sales. So we debit sales returns and allowances, and we credit AR because they no longer owe us that amount. Okay, we're good with that. On July 11th, what if they receive payment for the balance that is due? So that's within the 10-day period. Let's talk about when you've got an outstanding receivable. The outstanding receivable is now for $900, okay? But they have paid us back within that 10-day window, so they have taken advantage of a discount. So we need to record the fact that we received cash from our customer within that window. If they would have paid the next day on the 11th day, it would say cash, debit cash for $900. They would have written us a check for $900. We would have received $900, and we would have zeroed out accounts receivable for $900, and that's it. Okay? But since they paid and took advantage of that discount, we also have this discount to contend with. So we only received $882 cash because they took advantage of the 2% discount of their outstanding balance. And now we record a sales discount. And a sales discount is, again, kind of like sales returns and allowances. It reduces the overall sales revenue, okay? Everybody good with all this? We're good with the debits and credits of accounts receivable? Yep. Some retailers issue their own credit cards. If you recall, we talked about this a little bit, and you may talk, I can't remember if we talked about it I think you do talk about it in Intermediate 1. Assume that you use your JCPenney credit card to purchase clothing with a sales price of $300. Okay, so if you walk in and use your credit card for $300, JCPenney will record accounts receivable of $300 and a sales revenue for $300. Okay, and at the end of the period, if you owe them the $300, they will charge you, and they might charge you 1.5% per month on the balance due. They will record an additional revenue for that interest. Okay, so they will credit interest revenue because they've not only earned a sales off of you of $300, they've also earned an interest revenue off of you for $4.50, and they'll have another receivable. Could be an interest receivable or an account receivable, whatever. Okay. Okay, those are the basic journal entries for accounts receivable, selling things on account. Let's work out a problem. The problem that I want to work out deals with the fact that we've got those customers that don't want to pay their bills, or that may not pay their bills in a timely fashion. Okay? So again, let me kind of walk through the concepts, and then we'll go through this problem. I showed you the basic journal entries for selling things, recording accounts receivable. Now, when we talk about accounts receivable, when you talk about accounts receivable in accounting, intermediate accounting, we're going to talk about the fact that you've got customers that don't pay their bills. So you've got this outstanding account receivable. You need to build in a cushion, okay? The cushion that you build in to account for people who are not going to pay their bills is an allowance for doubtful accounts. The allowance for doubtful accounts, or allowance for uncollectible accounts, is a contra asset that goes to reduce the value of accounts receivable. So accounts receivable has a debit balance. This contra asset, called your allowance, has got a credit balance. Okay? That credit balance is a big old guess by management. Okay? It's a big old guess to try to figure out what you think will not be paid back from your customers. Okay? Whenever you build this guess, this allowance for doubtful accounts, you're hitting your expense account called bad debt expense. Because selling things on account and having everybody not pay their bills is a cost of doing business. It's an expense. So you record a bad debt expense that hits your income statement as you are building up this contra asset called allowance for doubtful accounts or uncollectible accounts or whatever. Everybody understand that concept? So when you are debiting and crediting to build up your allowance, It gives you that cushion for the unpaid collections. You are hitting bad debt expense by debiting bad debt expense and crediting your allowance for doubtful accounts. Your contra asset. Okay? Your net realizable value, and I probably should be writing this down now. Your accounts receivable on your financial statements is stated at net realizable value. Talk through this, y'all know this. Accounts receivable on your financial statements, on your balance sheet, is recorded at net realizable value, which is your accounts receivable, everything that is owed to you, minus your allowance. Okay? Your net realizable value is exactly like it sounds. It's the amount that you think you're going to realize, you're actually going to get from all of your outstanding receivables. NRV, your net realizable value, is your AR minus your allowance, that contra asset. And you build that allowance by hitting your expense. Everybody good with this concept? Yes. We come up with that guess in a couple of different ways. A lot of times we use this bucket method, which is called the aging of accounts receivable. We're going to go through these little columns, these buckets over here. So we use the aging method, or we might use a percent of total accounts receivable. Okay, so there's a couple different ways to come up with this guess. One of them is the aging method, and it shows basically it follows the notion that the longer that something is outstanding, the less likely you are to collect it. So if you take all of your outstanding accounts receivable, if you've got $377,000 worth of outstanding accounts receivable from your customers, you put them into age buckets or age columns. 222 have only been outstanding from 0 to 30 days, so they're pretty current. These guys all the way over here haven't paid their bills for over 120 days. They have outstanding IOUs to you for over 120 days. These guys, you think you're going to get paid back a lot. 99% of the time, you're going to get paid back. Only 1% of the time, you think you might not get paid back. So you're going to estimate the uncollectible amount related to this current bucket at 1%. These guys over here pay back at a much lesser rate. They only pay back 90% of their bills. So you've got an uncollectible amount of 10% related to these old outstanding IOUs. So that's the way this aging method works. And this looks silly, this looks textbooky, but it's the way that people do it. I've seen it in practice, I have done it in practice, I've audited it in practice. This is actual reality, it's not just textbook. Okay? Reynolds uses the allowance method of accounting for bad debts. The company produced the following aging of accounts receivable at year end. Okay? So what we want to do is we want to calculate the total estimated bad debts based on the above information. So let's do that right now. We are going to come up with a total estimated bad debt amount, this little square right here, and that's super easy to do because all we do is add up all of the outstanding amounts from the other buckets. So if we think that of the $222,000 of outstanding AR that is 0 to 30 days old, we think 1% of that is uncollectible. That means that 2,220 of it is our best guess of what we are not going to collect of that amount. Okay? Of the $90,000 that's 31 to 60 days outstanding, we think 4% of it we will not collect. 96 we'll get. 4% is our best guess of what we will not collect. So if you do the math, that's 3,600 of the 90,000. Okay? The next bucket, 5% of our 61 to 90 day outstanding AR is not going to be collectible, and that's $38,000, so it's $1,900 is our estimated bad debt amount. If you keep going in the 91 to 20 day bucket or column, $15,000, 8% of which will be uncollectible, or $1,200. And then the last one, the over 120, the $12,000 at 10% is another $1,200 that we do not think we are going to collect. How do they come up with these percentages? It's management estimate. It's based on history. It's based on industry averages. It's based on whatever. Most of the time, it's based on history. You go back and look at what you collected in months, years past. Okay? You add all of those up. What the company is saying. That $10,120 is what they estimate to be uncollected. Uncollectible. Okay, so what we need to do now is we need to true up financial statements. Let's true up financial statements to show that we have an outstanding balance of bad debts of $10,120. So in part B, we've done part A. Let's walk through this. Prepare the year-end adjusting journal entry to record the bad debts using the aged uncollectible accounts receivable determined in A of $10,120. Assume that the unadjusted balance in the allowance for doubtful accounts, or allowance for uncollectible, or whatever, is a $4,000 debit. Okay, so if you look at our T account for our allowance for doubtful accounts, or allowance for uncollectible accounts, or whatever you want to call it, it's got a $4,000 debit balance. We know $4,000 debit. We know that we need to build this amount up, and we want it to be $10,120. Okay? We've determined that this is what we want it to be. So we need to build our allowance back up. Okay? I have told you that the way we do that is by recording a debit to bad debt expense and a credit to our allowance for doubtful accounts. It's got a natural credit balance. We know we want this to be $10,120. So what do I have to record in my new 14, yeah, 120. Okay, so we need to record a $14,120 balance, entry to bad debt expense, and a credit to allowance for doubtful accounts of $14,120. Okay. The reason we might have had an outstanding or a previous balance of $4,000, a $4,000 debit in our allowance is because we guessed last period what our allowance was going to be, what our allowance should be, and it ended up being more. So we dipped into that a little bit too more. So we have to build our allowance back up even more than what we guessed. Okay? Everybody cool with this? Okay. Now let's see. That was part B. Now, of the above accounts, 5,000 is determined to be specifically uncollectible. Okay, prepare the journal entry to write off the uncollectible accounts. So now what we want to do is we need to write off $5,000 of a specific account. So we have built up an allowance. We reported the fact that we have built up an allowance. We now have an allowance for doubtful accounts of $10,120 related to the outstanding $377,000 of accounts receivable. And now somebody walks in and says, I'm sorry, I've gone bankrupt, you're never going to get the $5,000 that I owe you. Okay? So we built up the allowance, now we need to use part of that allowance. So when we write off $5,000, we are using part of that allowance. When we use that allowance, we just debit the allowance for doubtful accounts. That's what it's built up for. Okay? We built it up to $10,000. Now we are using $5,000 of it. And when we record the write-off, we need to reduce the AR, the overall accounts receivable balance, for $5,000 as well. Okay? You don't record the expense. You don't record the expense because the expense is only comes into play when you're building up that allowance. Now what we're doing is we're using that allowance. We're dipping into that $10,000. And we're crediting accounts receivable because they are not going to pay us back. We need to remove them from our outstanding accounts receivable. Okay, now D says the company collects $5,000 subsequently on a specific account that had previously been determined to be uncollectible. So now they walk in and they say, haha, just kidding, I won the lottery, now I'm going to be able to pay you back the $5,000. Okay? So all we have to do in D is we need to kind of undo this, okay, and then record the fact that they pay us. So I like to do it in 2 steps. First, let's undo this. We had written them off, so let's unwrite them off. We put them back into AR for $5,000 and unuse the allowance for $5,000, right? So So everything was as it was before we wrote them off. And they're walking in and saying, here's the money that I owed you, okay? So all we do is record cash, debit cash for $5,000, and credit AR for $5,000. Okay, when you're really slick in your intermediate class, all you're gonna do is debit cash for $5,000 and credit allowance for $5,000, because these two just zero each other out. You can see. That's the way you think about it. Our big 30,000 foot view of our allowance entries, reporting our allowance. We're good with this? Yes. Okay. Now, the last little step. Comment on how your answers would change if Reynolds used 3% of the total accounts receivable method instead of the aging method. Okay? If they said, you know what, we don't want to use the aging of accounts receivable method. Okay? We want to use the percentage of accounts receivable method. We have $377,000 of accounts receivable. And we're guessing, instead of aging all of our accounts receivable, we're just saying, you know what, generally about 3% of the time, people do not pay their bills. Okay? That number would turn out to be, I think it's 11,310. Is that right?
Yeah.
So they're coming up with a different way to come up with this guess. So under this aging method, we guessed about $10,000. Under this method, we are guessing about 11,310. So our number would just change. Okay, our debit up here, when we recorded our building up of our allowance, our recording would be a debit to bad debt expense for 11,310 plus the $4,000 that was debited, so it would be 15,310, and our credit would be allowance for doubtful accounts for 15,310. Cool. Okay, everybody good with accounts receivable? This is the basics of it. We know how to, we've got 5 or 6 slides to show you how to record basic receipt sales using AR, sales returns and allowances, sales discounts, collection of receivables. Then we come up with we know how to come up with our allowance. There's a couple different ways to do it, and we know how to journalize that. Okay. Next up is inventory, I think. Rocking and rolling. Inventory. When we talk inventory, that's when we sell stuff, okay? Some companies sell services, some companies sell stuff. We're talking inventory, we've got a warehouse full of stuff that we are selling, okay? We are talking inventory, we need to record, we need to figure out what the value of that inventory is, okay? And then we need to figure out what the value of what we sell is. So as we sell things, we need to record that sale as well. So take a look at this one little slide, and let's walk through the 2 journal entries, kind of like what we did just before. Assume that JCPenney sells 80 dresses that cost costing $20 each to customers for $10 each dress. Look, to record the sale, what do you do? Okay, so we sold 80 dresses for $110. 80 people walk in, they all bought a dress, handed us $110. So we recorded a debit to cash or accounts receivable for $8,800, and we recorded a sales revenue for $8,800. Okay, and just like a couple of minutes ago, we don't want to forget the fact that we also have to record the idea that 80 dresses are no longer in our inventory. We reduced the value of our inventory. We had valued all of them at $20 each because that's how we bought them from our vendor. So is that right? 80 dresses. That should be 1,600. 1,600 right here. We reduced the value of our inventory by 1,600. Sorry, guys. And we record an expense. This cost of goods sold is an expense. So if we built a financial statement, if we built an income statement just from this one transaction alone, we would say revenue, 8,800, minus cost of goods sold, which is an expense, for 1,600. We have a net income related to this sale, 8,800 minus 1,600. Okay? The inventory of 1,600 would be what is sitting on our balance sheet. Okay, as with the cash or the receivable. Everybody good with that? That's the basic journal entries for inventory. You record a sale, you also record the cost of goods sold related to it. What comes into play when you're talking inventory is the value of that inventory and the value of that cost of goods sold is different. I've got 80 dresses in my warehouse. I told you they were all worth $20, but in reality, I might have bought some of them for 20, I might have bought some of them for 18, I might have bought some of them from my vendor for 22, okay? And when I'm pulling out these dresses, am I selling you the $18 one or the $20 one or the $22 one? You don't know. Okay, so there is a cost flow assumption that you have to make when you're talking about inventory. Inventory that companies purchase from their vendors varies. It is not always static. It is not always $20. Okay, so we're going to go through, and the reason we go through this is we talk about 3 different ways to value this. Okay, FIFO, which is first in, first out. The first items that you purchased are the first items that you sell and record as a cost of goods sold expense, show up on the income statement. Okay. LIFO, last in, first out. The last items that you purchased from your vendor are the ones that you are going to record as sold to your customers in cost of goods sold, show up on the income statement. Okay. And then average cost is you open up the warehouse, take a big old average of all of the things that you have in your warehouse and get an average cost. Okay, so we're going to go through this one problem, do it 3 different ways. When you get into intermediate, you're going to build on this. Okay, we're doing this in a very simple way, going through LIFO, FIFO, and average cost. You're going to go through moving average cost. You're going to go through different types and making these cost flow assumptions more complex in your intermediate class. But right now, what we're doing, we're just going to go through it in a very simple, high-level way so that you are ready to go through it in a more complex way. Okay, so we've got a quick problem here. We've got our Horn Inc. uses a periodic inventory system, periodic versus perpetual. We use periodic system. Its records show the following for the month of May, in which 72 units were sold. Okay, so we had, in May, we had a beginning inventory of 30 units. We purchased along the way 25 units and 38 units. So in total, we have 93 units that are available for sale. Okay, 93 units that were available for sale. We sold 74 of them. Okay, so 74 of them are going to be assigned to cost of goods sold. The remainder, 19 of them, I guess, 19, yes, are left in the warehouse. So 74 dresses have been sold, 19 are left in the warehouse. Which cost do we assign to these ones that are sold? Which ones do we assign to the ones that are left? Okay, we have dresses in our warehouse that cost us $9 or whatever it is, that cost us $10 and that cost us $11. Okay, so we need to go through this and assign costs using FIFO method, the LIFO method, and then the average cost method. Okay, so let's do FIFO. FIFO is first in, first out. And the way I like to do FIFO is I start with our cost of goods sold. Let's figure out what our cost of goods sold is. The first units that we purchased, these stuff up here that were in beginning inventory, are the first that we assign to our cost of goods sold. We're going to go down and we're going to sell 74 dresses. We're going to start at the top and assign cost to those dresses that we sell. We're going to sell all 30 of these dresses that cost us $9 each. Okay, so that's part of cost of goods sold. Thank you. God, you are awesome. Next, let's go into the next layer. There's 25 dresses that cost $10 each. We're going to sell all of those and assign that to cost of goods sold, $250. So far we have added 55 dresses into our cost of goods sold, so we need to sell how many more? 19 more? 19 more? 19 more of the dresses that cost us $11 from our vendor, which is, I didn't do the math on this. 209. So in total, what is our cost of goods sold? $729. Okay, everybody good with that? Yeah. The way you get ending inventory, you can either just subtract that from the total of 938. Okay, what's left in ending inventory? 938 minus 729. 209. You could also do it magically and work backwards, work up if you wanted to. and just take the remaining items that were in this last bucket and multiply them by $11 each, okay? But using FIFO, these two numbers tell you that of the dresses that you sold, you're assigning a cost of goods sold of $729. That's what's going to show up on your income statement. And you're going to have an ending inventory of $209, okay? That's going to be left on your balance sheet. FIFO. Same thing, just totally different. I always like to do cost of goods sold first, and I think the intermediate textbook does it the same way as well. Cost of goods sold, LIFO, is last in, first out. So now we're going to start at the bottom. We had 38 dresses that cost us $11 each, or $418 are going to be assigned to cost of goods sold. We are selling 74 total dresses, so we are going to sell all 25 of the dresses that cost us $10 each. Okay? And then we keep going up. We go up to the next layer. And to get to a total number of dresses sold of 74, I think we need 11 more dresses. So we're going to pull 11 dresses from the $9 layer. And they cost us $99 each. And so our total cost of goods sold, assuming using the LIFO method, is $767. Okay? And again, you can calculate ending inventory by working from the top and going down. So the 19 dresses that are left in ending inventory, you can just multiply it by 9 and get your ending inventory of 171. Or you could subtract it. You could take the total, 938, the total cost, and subtract off your cost of goods sold. Okay? But either way, that's how you calculate it. Everybody's good with this? Yeah. We know LIFO, we know FIFO. Let's do average cost real quick. We have an average cost. We're doing our average cost. We have $938 worth of inventory. We have how many units? 3 units. So on average, our inventory costs $10.09-ish, something like that. It says to round to the nearest 3, but whatever. $10.09. Each dress, on average, costs $10.09. So when we are coming up with cost of goods sold, we sold 74 of those suckers, $10.09 each, which is approximately $746-ish, okay? And I'm rounding. And we have 19 that are left in ending inventory that we did not sell that have an average cost of $10.09. We're about $191-ish, okay? This is the basics. Everybody good with that? Inventory, we are good. Awesome. Awesome, awesome. Y'all are doing great. We're going to keep going. Long-term assets. Okay, so I'm marching down the balance sheet. We skipped cash. Cash is easy. We talked about AR and the allowance and how to calculate that. We talked about inventory, LIFO, FIFO, average cost. We're building onto that in intermediate. Now we're going to talk about long-term assets. You buy a truck, you buy equipment, you buy fixtures and furniture, you buy computers. All of those big things that you use to run your company are long-term assets. Okay, it's non-inventory. It's not stuff you are selling. It's the big stuff you need to run your business. Buildings, plants, delivery trucks, desks, computers, fixtures, like at the Gap or whatever, that you put the t-shirts on. Okay, all of that is long-term assets. The reason we talk about long-term assets, we have to depreciate long-term assets. We keep them for longer than a year, and they wear out over time. So we have a cost of doing business called depreciation expense. So if we've got a big pizza truck from our good old 2301 textbook that was $12,000. To record that purchase, when we bought the truck, we increased our assets by debiting truck for $12,000, and we credited cash if we paid for it with cash, or we credited accounts payable if we are going to pay for it later, right? And then we record depreciation each year. Whenever we record depreciation, this is what your debits and credits always look like. You debit depreciation expense, you credit that accumulated depreciation. This accumulated depreciation reduces the overall value of that asset up there. So your net book value of your long-term asset is $12,000 equipment, less accumulated depreciation of $2,000. Okay, so over time, this amount grows on your balance sheet. This contra asset grows. So the overall value of your asset shrinks. Okay, so to record the depreciation, assuming that it's $2,000, again, you record a debit to depreciation expense, a credit to accumulated depreciation. We're good with that. Okay, the reason we talk about it in our accounting textbook for a whole chapter, you're going to do it again in Intermediate 1, is there's different ways to come up with that $2,000. Okay, we've got the three main ways that we'll talk about right now. You've got the straight line depreciation method, where you just depreciate the same amount every year, regardless of how much you drive the truck or use the truck or whatever. Straight line depreciation, okay, where it's 2,000, 2,000, 2,000, 2,000, okay? Or you've got the an accelerated method called the declining balance method. Most of the time it's double declining balance. Sometimes it's 1.5, sometimes it's different declining balance, but double declining balance is the most popular declining balance method, which assumes that you depreciate a lot at the very beginning of the asset's life and then less over time. Okay? With the idea, you know, I use a car as an example. The moment you drive a new car off the lot, it becomes worth significantly less, and then the depreciation tapers off over time. And then the third method that's sometimes popular is a units of activity method, which can be all over the map, depending on how much you use the asset. A delivery truck, in years that you drive it a lot, should be depreciated a lot because it's working a lot. In years that you drive it less, it should be depreciated less because you're using it less. So it could be based on mileage. It could be based, if you're talking about some sort of plant machine assembly line, it could be based on the number of hours that the assembly line is used or turned on or whatever, machine hours, okay? So there's different ways to depreciate. These are the entries to record depreciation in your financial statements, and you know where these show up. Equipment shows up as an asset. This is a contra asset to reduce the value of it. Depreciation expense is an expense in your income statement, and then cash or accounts payable is also in your balance sheet. Okay, let's go through our three different methods for recording depreciation and make sure we know how to do those separately. Make sure I know how to do it. Whew. Okay. In recent years, Bar Company has purchased 3 machines. Because of the frequent employee turnover in the accounting department, a different accountant was in charge of selecting the depreciation for each machine, and various methods have been used. So information concerning the machines is summarized in the table below. We've got 3 machines, one that was acquired in January of 2012, July of 2013, November of 2013. Those are the costs of each of those machines. They all have a salvage value associated with it. If you remember what the salvage value is, it's the value of what it's worth at the end of its useful life. If you took that machine and took it to the salvage yard, the junk yard, you could get $12,000 for that one machine, or $10,000 or $6,000. So it has a value at the end. So we only depreciate an asset down to its salvage value. You don't depreciate it past its salvage value. It's got a value at the end of its useful life. And then it's got a useful life in a number of years, and the different depreciation methods that they use for these 3 different machines. Okay. For the declining balance method, they use the double declining rate, okay, and sometimes we talk about there are different declining rates, 1.5 times declining rate. Double is the most popular though. For the units of activity method, the total machine hours are expected to be 30,000. Actual hours in the first 3 years were 800, 4,500, and 6,000, okay? So that just gives us enough information to solve this problem and calculate depreciation. What we want to do is we want to compute the amount of accumulated depreciation on each machine at December 31st, 2015. Okay, December 31st, 2015. So first, let's go through and do straight line. That's first, straight line. Okay. When we record straight line depreciation, we always take our cost and we subtract off our salvage value to get to some depreciable cost. How much are we going to depreciate?
84,000.
Okay, and then we divide that by its useful life to come up with our annual depreciation. Okay? taking its depreciable cost, which is just its original cost, taking out its salvage value, okay? Dividing by that useful life to come up with it in annual depreciation. So in 2012, in year one, 2012, we had a $96,000 asset that had a $12,000 salvage value. So its depreciable cost was what, $84,000? Its useful life is 8 years.
10,000.
Thank you. So we are going to depreciate it by $10,500. Everybody see that? Year one, we're going to depreciate it by $10,500. And we bought it on January the 1st, so it's a full year depreciation. Okay? In 2013, same thing. You don't really have to go through this again. But we've got a depreciable cost of $84,000 that we are going to depreciate over an 8-year life. So its depreciation expense is $10,500. Same thing for 2014. Same thing for 2015. Okay? Straight line's easy. You have to remember to take into account the salvage value when you're calculating straight line. Okay? But each year you depreciate it by $10,500 over its 8 years. And after 8 years, it will depreciate down to its salvage value. So its net book value on the financial statements will be its salvage value. Everybody good with that? Okay, now let's do the declining balance method, the second machine. Okay? The double declining balance method. Okay? Double declining balance method. When you talk about double declining balance, the first thing you have to do, my little trick, is the double declining balance is basically double the straight line balance, okay? So what I like to do is you figure out what your straight line rate is. And those of you that were in my class did it this way. You may have done it a different way in your intro classes. The intermediate textbook is basically like this. Your straight line rate is it's an 8-year salvage, so it's 1/8.
This was 5 years.
Oh, sorry, thank you. That's why I have here, because I have no brain. 1/5 or 20%. So its straight line rate is 20%. Okay, we are depreciating this second asset that has a useful life of 5 years at 1/5 every year, or 20% every year. And then, oh, the beautiful thing about double declining balance is you just double it. Double the straight line rate. So 20% times 2 is 40%. Okay? We are going to depreciate this asset at a rate of 40% per year. Double declining balance. Okay? So you figure out your straight line rate. I like to do it in a percentage, and you just double it. Okay? The trick to calculating the double declining balance is that you do not take salvage value into account when you're making the calculation. Okay? Don't subtract salvage value to get to your depreciable cost. You are taking you are applying the double declining balance rate straight to your cost. Okay, so in this example, this is an $85,000 asset. So in 2012, we've got an $85,000 asset that you apply your 40% rate to. Okay. So if this was a full year, you would be depreciating that by, what's 85,000 times 40? Sorry. 34 something? Okay, 34,000. Sorry, I should have this calculator. But since we bought this in the middle of the year, in July, we're only depreciating it July, August, September, October, November, December, 6 months, okay? So you have to multiply this by 6/12, so 17,000. So the depreciation expense in year 1 in 2012 is 17,000. Everybody cool with that?
Yeah, but
Okay.
it's
2013.
Am I doing it? Oh, 2013, thank you. See? Okay, we'll go through it and do it again in 2014. Now what we are doing, when we apply our double declining balance rate, we are applying it to our net book value. So we are applying it not to the 85,000, but to our existing net book value, which is 85 less the 17 that we had already depreciated it in year 1. So that's 68,000 times our 40%, and in this case it's a full year. So if you calculate that out, it's 27,200. So our depreciation expense for 2014 is 27,200. And then in the last year, we're doing the same thing. We are subtracting, starting with 85,000 minus the 17,000 minus the 27,200. So the current net book value of the asset in this case is 40,800. We apply our double declining balance rate to it. And we get 16,320. Okay, so we have recorded depreciation for those 3 years. We don't need to worry about checking it against the salvage because we're not at the end of its useful life. That's the double declining balance method. The last one I want to use is the units of activity. So for the units of activity method, the first thing that we want to do is we want to calculate a per hour rate. So we have a $66,000 asset. We take, in this case, we take salvage into consideration. We have a $6,000 salvage value. So our depreciable cost is $60,000 for this asset. We want to depreciate $60,000.
Says,
Am I doing this wrong?
says for units of activity method, same machine hours are 30,000.
So yeah, what we want to do is we want to figure out a per hour rate, assuming that we're going to use this for 30,000. So we're depreciating $60,000 over an assumed useful life of 30,000 hours, machine hours. So every hour that it is used, we depreciate it by $2. That's the way this units of activity works. Is that cool? And then all you do when you calculate it, in 2013, they said that they used it 800 hours. So you take 800 hours times 2. So the depreciation expense for 2013 is $1,600. In 2014, they said they used it for 4,500 hours at $2 an hour, or $9,000 is its depreciation expense. And then 2015, we depreciated it, or excuse me, we used the machine for 6,000 hours. We depreciated it $2 every hour we used it for $12,000. Okay? So these amounts right here are the depreciation expense for each year. Okay? The accumulated depreciation for each year is just the accumulation of all of these. So the accumulated depreciation in year 1 is just $1,600. The accumulated depreciation in year 2 is the $9,000 and the $1,600. Accumulated depreciation in year 3 is all 3 of them. Okay? Everybody good with all these? Oh my gosh, y'all very nice. Spreading. Okay, hang in there. We're gonna keep going. We're gonna keep going. We talked about accounts receivable. What's our problems? We talked about long-term assets. inventory and worked out a good review for life of FIFO average cost. We just did depreciation and calculated it using the 3 popular methods. I'm going to walk through some concepts in long-term liabilities and equity. I don't know if we're going to get to cash flow, folks. We'll see. Bonds. Okay, bonds are a tricky thing that you're going to cover. You know what? Bonds are intermediate 2. I just realized
Bonds are
this. They are intermediate 2.
But they're also an intermediate one also.
They are.
They're intermediate one also. When you have to do the table and you amortize the bonds.
Amortize it all. Okay, let's go. Let's do it. Let's do it. This is gonna be fun. Bonds. I was thinking it was just intermediate 2. I just had this realization, but it's not. Intermediate 1 does cover a little bit of bonds. Bonds are those long-term liabilities. So we've got lots of long-term liabilities like notes payable. You walk down to the bank and get a bank loan, and you pay them back over time. Or mortgage payable. You pay back your mortgage over a period of 15 or 30 years. You also have bonds, okay? And bonds are something that we stop and talk about in intermediate because there's funky accounting for it and amortizing these bonds. The way bonds work is they are debt. They are not equity. There's no ownership related to bonds, okay? But it is a way to finance your business. It's debt financing versus equity financing like issuing common stock. When you issue bonds, you are issuing bonds and getting cash in return. So if I'm a company and I issue bonds to individuals, to other corporations, to what have you, and I get cash in return. It's a liability because I have to pay it back, usually at maturity, whatever the life of the bond is, and I also have to pay interest along the way, where I pay interest on that bond. Okay? Bonds are, that sounds really easy because there's just a payable and then an interest component to it. But there's a little bit tricky because there's some differences when you're talking about the market value of the bond. Okay, so I'm going to walk through this very quickly just to give you the concepts of bonds, and then we'll talk about amortizing the bonds, whether they are sold at a discount or at a premium. So bonds are a form of interest-bearing notes payable that are issued by corporations, universities, agencies, what have you. They're typically sold in nice round numbers, $1,000 bonds, $500,000 bonds. When a corporation issues bonds, it is borrowing money. It issues out pieces of paper and gets money in return, so it's borrowing money. The person who buys the bondholder is investing, so it's an investment for people. When you have bonds, when you issue bonds, you are issued, they are issued to the investor. They have the name on the bond. There are lots of it's a pretty piece of paper that's got things like the name, the face value, the $500,000 amount, a maturity date, 10 years is its maturity date, 10 years from now, and a contractual or a stated or face interest rate. So there's an interest rate that's included on that bond, 5%, 8%. There's a number that's on that bond that says what the interest is, okay? The face value is the principal that's due at maturity. The maturity date is that date in the future when the bond is due. And then the contractual interest rate, the stated interest rate, is the rate to determine what interest you are going to receive. So if your bond says 10% on it, you're going to receive 10% interest if you are the bondholder, 10% of the face, regardless of what the market is doing. Okay? So the stated rate of interest tells you the interest rate. The way we work bonds is we have to come up with the present value of both the principal, the face of the bond, and any future interest payments. Okay? So if we've got a bond, assume that Acropolis on January 1st, 2014 issues a $100,000 9% bond that's due in 5 years, okay, with interest payable annually at the end of the year. And the way we would come up with today's value of the bond is we would take this $100,000 principal, because the bond says $100,000 on it, and when that bond is issued, we know that at the end of 5 years, that company has to pay back the bondholder $100,000. Okay, so that's what it's stated. We also know that it has to pay interest each year, and it's 9% of that $100,000. So 9% of $100,000 is $9,000 each year. So the required payments, the corporation that issues the bond, is those 9% interest payments each year for the 5 years, $9,000 each, and the $100,000 at maturity. Okay, So, to come up with the present value of those future amounts, we use our time value of money concepts that we learned in intro that we'll use again in our finance classes and our intermediate classes. So we've got a present value of a single sum. Okay, we know the future amount, so we come up with the present value of it using our calculators or our tables. And then we've also got the present value calculated of an annuity, those systematic payments over time. Everybody remembering this, recalling this from our intro? Yeah, we'll use it again when we talk about bonds later on, and we talk about it in our finance classes, to come up with the current market price of the bond of $100,000. Okay? That's the way the bonds work, that's the way they are valued. Okay? Let's talk about how they are accounted for. Okay? How we debit and credit them. When we debit and credit them, let's just go through an example. DeBoer Corporation issues 100 5-year 10% $1,000 bonds dated January 1st, 2014 at 100, which means 100% of their face value. The entry to record the sale is what? So they have bonds that are all that are $1,000. There's 100 of them, so it's $100,000 worth of bonds. It's 5-year 10% bonds. So when they issue them, they are issuing out bonds and receiving cash for it. So they debit cash for the $100,000, and now they have an outstanding liability, long-term liability, because it's a 5-year liability of bonds payable for $100,000. The entry to make the interest, to record the interest that is earned or owed at the end of the first year would be to take your principal times your interest rate times your time, 1 year. So after 1 year, they owe $10,000, 10% of the face value, okay? At the end of the first year, they have to record an interest expense and an interest payable. They haven't paid anything yet, so you record a debit to expense, a credit to payable. So after year 1, they owe $100,000 plus $10,000 interest. They do that again for 5 years, right? 10,000, 10,000, 10,000, 10,000. And then the bondholder walks in at the last day of the 5th year, and the corporation has to pay back the $100,000 of the face. They also have to pay back all the interest that is owed, okay? And that's the way the bonds work from a journal entry point of view. Oops, well in this case they paid it the very next day, I'm skipping this. Now, let's talk about the more complex issue related to bonds. Bonds sound really easy if I just explain them in that manner, okay? They are issued at face. What oftentimes happens is they are sold at either a discount or a premium when the market value doesn't mirror the piece of paper value, okay? So if I've printed out bonds, I've got bonds that have 10% written on them. I'm paying 10% to anybody who buys one of my bonds. So I pay 10%. Market may be paying 10%, they may be paying more, they may be paying less. So if my competitors are paying something more or less, I need to adjust the value, the price of my bond, the original sales price of my bond. Because I know regardless I have to pay them $100,000 at the end, okay? But I need to adjust my sales price at the beginning to even the playing field with my competitors. Because I don't want to pay too much for my bonds, or if I pay too little, no one will buy them from me, okay? So in order to stay competitive in the market, I need to adjust the sales price of my bond. And I do that by looking at the market and seeing what everybody else is selling their bonds at. So if all of my competitors are selling bonds with an 8% rate, okay, they have 8% written on their bonds and I have 10%. I am paying too much interest because I'm paying 10% interest, they're only paying 8. So I'm going to charge more for my bond up front. So I'm going to issue that bond at a premium, okay? Make sense? If we're both paying 10%, then I just issue it at face, my competitors issue it at face, and everybody is happy, okay? If I, on the other hand, am 10%, I'm paying 10%, my competitors are paying 12, no one's going to come and buy my bond, so I have to entice people to buy it, so I sell it at a discount, okay? And so what we have in play when we're talking about bonds is two things. We've got the interest component, and then we've got the difference between our bond issuance at face or discount. We have to amortize the difference between those two. And you had done that in your intro classes. You're going to go on and do it in your intermediate classes as well. Okay? If it's face, it's really easy. But the amortization of the discount or the premium is also in play when we are talking about bond record the issuances of bonds. Assume that on January 1st, Candlestick sells a $100,000 5-year 10% bond at 98, which is 98% of face, so they issued it at a discount. The entry to record the issuance is as follows. We still have $100,000 of outstanding bonds payable, so we credit bonds payable for $100,000. We only received $98,000 cash, so we debit cash for 98. The difference is the discount. So we debit discount on bonds payable. So the net book value of our bonds on our financial statements on day one is $100,000 less the $2,000 discount, so it's 98, okay? On the flip side, if we issue bonds at a premium at 102, so in this case, assume that these bonds, this $100,000 worth of bonds, were sold at 102 or 102% of face value. Then we were to record it slightly different. Now we're getting $102,000 cash. We're selling these $100,000 bonds that say $100,000 on the face. So that's what we're going to have to hand back at the end of the bond's life. But we're getting $102,000 for it now. We are selling them at a premium. So the net book value of these bonds is 102. So now we're going to have to amortize that premium over the life of the bond. In addition to recording the interest, we also have to record the amortization of the discount or the premium to get the bond's value back to 100. Okay? When you redeem the bonds at maturity, whatever the bonds, you have worked that bond value back up to 100 after you've amortized the discount. I'm kind of glazing over this because you will go into more detail in intermediate one. All you do is the bondholder walks back in at maturity, hands back that little bond piece of paper. So you hand them back $100,000, so you credit cash for $100,000, and you take that bond payable liability off your financial statements by debiting it. Okay? Okay, so let's kind of walk through this longer example. This is it for, I think this is it for bonds. Let's see. So I need to. Yeah, we'll go through this, and then we may have to skip some of the problems because I do want to glaze over the rest of the class. Let's go through this one problem to make sure you know the basics of the debits and credits related to reporting transactions related to bonds. Assume at the end of the period, at the end of the 4 years of the 5-year life of the bonds that we talked about a minute ago, Candlestick, having sold its bonds at a premium, retires the bonds at 103, 103% of the face value, after paying the annual interest. So assume that the carrying value of the bonds at the redemption date is $100,400, okay? And the Candlestick, they would record the redemption at the end of the fourth period as follows. Okay, so let me just walk through this. I know some of the numbers may not be exactly gel, but you've got a bond that was originally sold at a premium, is what it tells you. Okay, and what they've decided is after 4 years of the 5-year bond's life, they've decided to call them and retire these bonds. Okay, so they call all the bondholders and say, we're pulling all these back in and we're going to pay you back. We're going to pay you back at a price of 103. We're going to pay out $103,000 instead of just the $100,000 that you were going to get this time next year at the end of the 5th year. We're paying you 103 right now. Okay, so they've got the company records a credit to cash for 103. They remove, when they retire these bonds, they're pulling them back in so they are no longer outstanding. So the bonds are debited at $100,000. So they are zeroed out on the financial statements. The cash that is recorded as a credit for 103. They had a premium that was still unamortized, okay, of 400. The remaining premium for that bond that had not been amortized for the 5th year was 400. And so they now have a loss, okay? They have a loss that they record relating to the retiring of that bond. Basically, they're buying bonds that are on the financial statements worth $100,400 that they are buying back for 103. Okay?
Do they not mark the interest that would be received?
They already recorded the interest itself. So this is outside of the interest. Okay. I'm going to skip the 2 problems I will send you the slides electronically so you'll have the solutions to them, okay? They're pretty easy to do, but I'm gonna try to glaze over, at least go through equity, and then we'll see if we get to cash flow. We have 20 minutes, and I wanna respect your time, and we wanna eat as well. I will send you the solutions. The purpose of this day is to make sure you've got good, basic, solid level mastery of the introductory stuff. I think you've got it. I wanna just walk through all of this, you walk in with confidence next week, and rock out equity. Yeah, equity. Let's talk about equity very quickly. We've got assets equals liabilities plus stockholders' equity. Stockholders' equity is in two pieces. Okay, we've talked about the fact that it has got the capital piece of it, okay, the ownership piece of it, and the retained earnings piece of it. So stockholders' equity, retained earnings. Okay, we talk about retained earnings statement and the capital piece of it. We talk about capital. Okay, when we talk about stockholders' equity, we've got common stock. A company will print up pretty shares of stock, issue them to anybody who wants to buy a share of stock and receive cash for it, right? It is ownership in the company. You can buy a share of Apple or Facebook or Google or whatever. You can buy one share of stock of Coca-Cola, and you are a part owner of Coca-Cola. And that part ownership piece is sitting in their equity section under the common stock line item, okay? There are also different classes of stock. So there's common stock, but there's also some other classes of stock called preferred stock. And those preferred stock, if you remember, have certain privileges. They have a right to receive dividends before the common shareholders. They get dividends in arrears oftentimes if it's cumulative preferred stock. They get some other rights that are a little bit cooler, okay? So there's different classes of stock. Regardless of what class of stock there is a line item related to different shares of stock called additional paid-in capital, or it's also called paid-in capital in excess of par. Okay, we have par value most of the time that's associated with stock, with common stock or preferred stock. Okay, anything that you decide to pay over that par value is that additional paid-in capital. So if I issue a share of stock that's a $1 par value, you give me $5 for it, I've got $1 related to common stock, so $1 sitting on my common stock line item in my equity section. My additional paid-in capital is the other $4. That's the way common stock is reported. Then we've got another thing related to common stock, related to stock in equity is called treasury stock. Occasionally, companies have the need to buy stock back out of the market to prevent a hostile takeover, to buy back stock so that they can give it in turn for stock compensation for their employees. There's different reasons that companies want to buy it back. So we issue shares of common stock, we issue shares of preferred stock. Occasionally, companies buy back stock in the form of treasury stock. We put it back in our treasury in the vault or whatever. That's what it is. And so when you record treasury stock, you kind of just flip the way that you record things because it's buying it back. Cash is going out, stock is coming back in. Okay, so it looks like this on the financial statements. You've got a line item or a section called common stock that always typically has a par value associated with it unless it's no par. And then retained earnings is the second piece of it. If we've got a company that acquires 4,000 shares of its stock at $8 per share, so they have bought that stock. This is just my little reminder to you that most of the time when you're issuing shares of stock, a company is receiving cash, debiting cash, and crediting common stock. But when they have decided to acquire stock back, it's the reverse. They're paying out $32,000. Okay, so they're crediting cash and they're buying treasury stock back. So treasury stock reduces the equity section. It's a reduction to the equity section. Okay? When we talk about preferred stock, if you think about, we've got classes of stock, common stock and preferred stock. Common stock is pretty easy to calculate. Preferred stock have priority in relation to dividends, as I've mentioned, and they get assets in the event of liquidation before the common shareholders. What they give up to get those rights is the right to vote. Matters that are brought forth to the shareholders for voting. Sometimes our preferred shareholders do not have that right to vote. That's what they give up. We've got our excess accounts, our APIC accounts, paid-in capital in excess of par. Each line item typically has their own paid-in capital in excess of par, or additional paid-in capital. You'll see it listed two different ways, different companies, different textbooks, different whatever. But that's that extra amount, that extra $4 that shareholders pay over a stated par value. Okay? Let's go through a couple of just examples to make sure we know how to record everything. Stein Corporation issues 10,000 shares of $10 par value preferred stock for $12 cash per share. Okay? Very easy. Kind of talked about it already. They're issuing 10,000 shares that have a $10 par value associated with them. So the line item called preferred stock is 10,000 times 10, or $100,000. They're paying $2 extra on top of that for each share. There's 10,000 shares, so it's a $20,000 paid-in capital in excess of par, or additional paid-in capital and PIK. And they're receiving $120,000, so debit cash. Okay? When we talk about equity, we've got dividends that we have to talk about, okay? Dividends are those payments to shareholders. So you own a share of Apple stock, you might get paid dividends. Companies earn their net income. They have two choices as to what to do with the income. They can keep it, retained earnings. They can hand it out to their owners, dividends, okay? So dividends are a distribution to stockholders on a prorated basis, proportional to the ownership. So if you own one share, you get dividends for one share of stock, whatever that is. Most of the time, it's cash dividends. You will, in intermediate, talk a little bit more about stock dividends and stock splits. I don't think you'll talk about property dividends or promissory notes, but they are typically, most of the time, you'll see cash dividends. Okay. Sometimes you'll see stock splits. We'll talk about stock splits in intermediate. Stock splits occur when a company decides that they may not want to give out dividends, but they want to split their stock, with the notion that when they split their stock, the market value increases, and so the value of your proportionate ownership share goes up. It's market driven, not dividend driven. Okay? Dividends are expressed as a percentage or as a dollar amount. We've got cash dividends. When we talk about cash dividends, I'm going through this very quickly. You've got 3 dates you need to keep in mind. There's a declaration date, which is the date the board of directors gets together and says, we are issuing a dividend of 50 cents. And then there's a record date, okay? And the record date just means that if you own a share of stock on that record date or strike date, you get the dividend. And then the payment date of the dividend is the date that the checks are actually written. So when you're talking about recording dividends on your financial statements, you record the fact that you're going to pay dividends, so you record a dividends payable on December 1st when the company declares they're going to issue a dividend, and then you zero out that payable and record cash on the payment date. Okay? The effects of stock dividends we've talked about. You know most of this, I'm sure. It changes the composition of stockholders' equity because it reduces that retained earnings amount. Total stockholders' equity remains the same, however, the overall value does. There's no effect on the par or the stated value per share, and it increases the number of shares outstanding. We were talking about stock dividends, not cash dividends. Okay. I'm going to skip this. Okay? So this is a little bit about dividends and stock dividends. And I'm going to skip, what do we do now? I'm going to skip this as well. Okay, I'll give you the solutions. This is just journalizing, issuing shares of stock, buying back treasury stock, reporting the payment of, this is interest. No, I think I saw them out of place. We're going to skip that, okay? I'm going to skip that, and I'm going to do a quick overview of cash flows, okay? We've got 10 minutes left. I'm going to talk cash flows for 5 to 10 minutes, and we will do that, okay? So I'm skipping the problems related to equity. I will provide the solutions to you. You'll have them. I feel like you probably know them and feel comfortable with them, okay? Cash flows. Let me give you an overview and a quick reminder about the cash flow statement. I don't have many slides on the cash flow statement because the best way to learn cash flows is to work through them. We're going to run out of time and not be able to work through them, but you are going to feel comfortable with them just because we're going to talk about them, okay? So cash flow statement, you know what a cash flow statement looks like. It starts with 3 different sections: operating activities, each section, it's the inflows and outflows of cash related to those types of activities. And I'll tell you what goes in those sections in just a minute. I'll remind you of that. You come to a subtotal to get to a total change in cash. So all the cash inflows and outflows are listed in one of these three sections. And then you get a total change in cash for the period. A total net inflow or a total net outflow for cash for the period. You add that to your beginning cash balance to get to your end cash balance. So what a cash flow statement does is it walks forward the beginning cash balance to the end of cash balance and tells you everything that cash has done in the interim, all the cash inflows and outflows. There are three sections of the cash flow statement, like I said. I like to explain it from the bottom up. Okay, bottom, starting with financing. Okay, very first thing you have to do when you start a business, when you start a health business like Alfonso, is that right? Adolfo, sorry. A health food business. We started the business, I think, didn't we? You and Corey in our class last semester.
No, that was cool.
It was just Corey. Oh, I'm sorry.
Yeah.
Okay, so whenever you start, sorry, you was one. And I don't even know your name. I'm such a bad person. Okay, so financing activities include anything related to financing your business. So when you start your business, you have to figure out how to get cash. I'm not rich. You're not rich. We have to figure out how to get cash to start up our business. So you can do it in one of basically three ways. You can walk down to the bank and get a loan. You can issue shares of stock, or you can issue bonds, those bonds that we just talked about. So, the cash flows related to financing activities are any inflows and outflows of green dollar bills related to stock, related to bonds, or related to long-term notes. So, changes in long-term liabilities, like those bank loans and bonds, or changes in stockholders' equity. Okay? Anytime cash changes hands related to those 2 or 3 items, goes in the financing activity section, right? Okay, so we financed our business. Let's assume that we financed our business. Now we need to do some investing in our business. We decided we got a whole bunch of cash, financed our business. Now we need to invest in it. So investing activities might include going out and buying a delivery truck, or buying a plant, or buying a factory, or any, those kinds of things. So investing activities include any changes in investments and basically long-term assets. Buying and selling of the delivery trucks, buying and selling of the plants. Any cash that changes hands related to that is an investing activity. So we've got financing activities, which includes how we finance our business through long-term liabilities and equity. We've got investing activities, which include long-term assets, all the stuff that we need to run our business. And then we've got operating activities, and that's actually running our business. So anything included in the operating activities are the inflows and outflows of green dollar bills related to selling jeans, selling dresses, buying shoelaces from our vendors, paying our light bill, okay? Any of those types of cash inflows and outflows go in the operating activity section. So all the cash flow statement does is it takes any time you pay cash or receive cash and categorizes it into one of those 3 categories. All business transactions can fit into one of those 3 and get created, okay? So you categorize it and put them in those 3. You come up with subtotals on your cash flow statement for operating, investing, and financing. That gives you your total change in cash. How much cash have you used or received in total for the year? Add it to your beginning cash balance to get to your end cash balance. That's all the cash flow statement does. When you talk about cash flow statements, all of you are going to be CPAs and accountants. You have got 2 different ways to create a cash flow statement. You've got the indirect way and the direct way. Okay, this very last slide, none of you know. You've got 2 different ways to do it. You can see how most public companies create their cash flow statement. The indirect way. There is a way called the direct method. Everybody uses the indirect method. The indirect method starts with a net income number when you're talking about cash flows from operations. Because we use accrual basis of accounting, right? We use a net income number. It manipulates your net income, makes some manipulations to it to get a cash flow from operating activities number. Okay? So it indirectly gets you to cash flows from operations instead of directly. The direct method actually lays out cash inflows and outflows from all your operating activities. Okay? So in the operating activity section, that's the only time the only difference between the indirect method and the direct method is in the operating activity section. The investing activity section, the financing activity section, it doesn't matter. The the operating activity section is only different in, when you're talking indirect or direct. We all use the indirect method. You start with net income, because that's what a lot of people care about is net income. You manipulate your net income to get to a cash flow from operations number, okay? And we've got those rules that we follow that we are not gonna do now in the next 6 minutes. Questions about the cash flow statement? No, that's a good overview. And I will give you the solutions to the problems that are in here. I'm done. Y'all are done. Y'all are awesome
All right.
at doing this. Yeah.
First off, let me thank
Yeah.
Professor Troutman here. If I had searched the world, and I did search around, okay? Yeah. We don't take any credit. I think she needs a round of applause. Okay. Just by a show of hands, was this beneficial to y'all? Yeah. So I already got feedback from people outside. I have my tweeter here. Okay. All right. I love her. My kids are saying, "John, you're on Dad, you're on Instagram," and I'm like, "Yeah," because Allison was the one who was sending those tweets and those Instagrams to y'all, and I thank her a lot.